Well, I hope everybody is having a good start to the month of June. The markets they're cheering, all green except for the VIX, getting crushed to a low that we haven't seen for quite some time. It's under the 16 handle. Almost all the sectors were up except for the two laggards down here, which tend to be more risk-off type sectors. They've been getting hit actually quite hard. There could be very well an opportunity there in a bounce, potential dead cat bounce in the near future. We're going to got a lot to talk about on today's stock market brief, but we're going to keep it to the point. If you're new here, welcome to the channel. That right there is a thumb. Make sure to hit that thumbs up. It's greatly appreciated. Now, we talked about this chart yesterday. This is the S&P 500, the spider, the spy, and we discussed what? We discussed, hey, if price comes down into areas of confluence, maybe look to buy down there. Don't get too scared if it does. Or if we start breaking out of this and reclaiming the week-to-date anchored VWAP, that can open the door to head up higher. What took place today? Well, bagoom! We had a massive, monstrous trend day. We started off down slightly here, boom, and then we recaptured that month-to-date, which is also the daily volume-weighted average price on a couple economic data points that came out. We then broke through the week-to-date, and we just trekked up on the 15-minute time frame, coming to where? The daily expected move. We pushed further through it, and as we were pushing further through this, I know Discord members know I put a little update out there. I don't typically do, but I put a little update that, hey, this would be the target that I'm looking for, which is the prior week-to-date high, and we came up there, got a little bit outside of it, and we broke back down into the daily expected move, and it then acted as somewhat of a flip, and then we started to move a little bit further from that. Going into tomorrow, well, what do we got going on? Well, we have some important jobs data coming out, so that's going to be something to watch. We'll talk about that momentarily, but 424.85 to the upside for the daily expected move, 418.79 to the downside. Now the downside, right, that would be bringing us back below the week-to-date and month-to-date anchored VWAPs, and that would tag us in with the 5-day moving average. Now this would probably come up a little bit more. This is probably going to go up a little bit more, right? So we'll see what price does within this area, but there's a lot of confluence of support between this 418 and this 420 if you are bullish and you potentially miss the breakout. I did not miss that breakout. I traded this, and you pretty much just had to hold long and just kind of enjoy the day. All right, if we take a look at the daily time frame, you can see, yes, we filled this gap. We hit a new high, and we had a new closing high for the year. We still have this gap above us that has not been filled, and it looks like we're in striking distance to potentially get there. Remember, if you're bullish, as long as we hold that quarter to date and, you know, stay away from breaking this low over here, things are looking pretty good. If we do start breaking down there, we have the year-to-date anchored VWAP, which is telling us what? Well, the average buyer, based off of volume and time, is in the green. Yay! Okay, so if we continue on, there are still some warning signs that I want to make everyone clear of, and that is looking at the weekly chart. If I look at the weekly chart, I want to first call out just a couple of things, right? It was a bullish day today, but where does that put us for the month? It puts us, for the week. We're up 0.37%, so not even a percent up, and we have one more trading day left in the week. Okay, and I just want to call out here that, you know, this is more Coco talking than me, but a friendly reminder that if we are still in a bear market, okay, if we're still in a bear market, just one of those single red weekly candles could potentially erase 8 weeks of the prior gains. Now, what am I talking about? Well, look at these red candles. Just take a look at the size and the authority of these red candles. You know, the most recent one here, we had one in 2023, right? This one right here. And just take into consideration that if we just had one of those candles, that right there could wipe out 1, 2, 3, 4, 5, 6, 7, 8, potentially 9 or more weeks of progress. Okay, remember, stocks, they take the stairs up and they could take the elevator down. And as I'm looking at this now, I'm looking, okay, well, we had a hanging man candle here. We're creating somewhat of a hanging man candle here. Yes, we're holding above the weekly 5 EMA, but if we start breaking down these weeks and closing below a low of a week or this 5 EMA, that could potentially start getting this to curl over and trigger potentially more sell-side activity into potentially the 50-week moving average, which is around 4,000, or potentially it could be higher, around 4,050. And now that's an important level because it's one of the levels that I've been talking about, that there's been some orders sitting around for multiple weeks down there at 4,000 and 4,050. However, we also called out that there is some liquidity above us that's been there now for multiple trading days, and that's at 4,300. Now, a trader that I admire, he had also mentioned that he likes to look at stuff with higher amounts of liquidity and that it stays there longer. Well, this one, it checks off that it's been staying there longer, but two, it's not the highest amount of liquidity as it stands at this particular point in time. It's at 359 orders. Down here is 395 and 418. So he said that, when it creeps above 500, he pays a lot more attention to it, and I would have to agree with that statement. Now, just to keep in mind, too, dating back even a couple weeks prior to that, when we were seeing some more red, remember, I think it was right around this point we were talking about it, that if we recapture the quarter to date, you don't want to miss going up into these gaps. And what we were talking about also was these orders back then, the 42.50 and the 42.45. Now they are kind of stacked onto each other and has quite a bit of liquidity, and price has been trying to get and absorb that. So I still think that they're still there. They've been there for a very long time. So I think that the chances of absorbing that at some point is becoming higher the longer it stays and, well, the closer we get to it. Okay, now going into tomorrow's trading session, we have an expected move of 42.59, which would take us where? It would take us up into this range, which would, if we got it, would absorb the liquidity just overhead, which could potentially lead us into more of a move squeeze, potentially into the coming weeks to 4,300. So that would be more the bullish case. Beneath us, the expected move is to 4,200, 4,204 to be exact. And there has been some interesting gamma exposure, so be aware of that as well. This can potentially act now as a more of an area of support. It was a very heavy area of resistance in the early trading day. If you follow me on Twitter, I said, or was it 4,200 or I think it was 42. I forget which exact level it was, but it was for the SPX, so ignore that. But there was a still incredibly important level to pay attention to. Now, if we go into the watch tool, what is causing this potential big move in the S&P 500 and these various markets? And it could very well be that we did have a gigantic shift in the Fed watch tool. And the Fed watch tool is tracking the probabilities of the rate hike. And what happened was Fed Harker said the FOMC should at least skip. And this word skip is kind of, the new reason to be very bullish here. And we saw a move down from just 1 week ago. We were at 51.7%, even higher than that, I remember, as the probability of doing a 25 basis point hike. And as soon as kind of the skip came, it flew us down over here. And, this shouldn't move that quick, but it's quite impressive that now the market is pricing in that the Fed is going to pause here. Now, we also had some ISM manufacturing, like we said, data come out today. Tomorrow is going to be non-farm payrolls. It's an hour before the market opens up. So be aware that the expected move that I discussed is, forward-looking risk. So we open up at 5:30. So we could always potentially open up at one of these levels because this catalyst is going to be coming up 1 hour before the market opens. As far as ISM coming out today, well, it dropped to 46.9 versus 47 that was expected. So we still remain in contractionary place there with the PMI. If we take a look at the updated Fed balance sheet, you can see it's still tapering off here. Liquidity draining could be one way of looking at this. And when liquidity moves out of the system, right? This was the banking crisis. Everyone's like, hey, we're back, baby. Well, now it's coming back down. There's various ways to look at liquidity. You can also look here at liabilities and capital, other factors draining the reserve balances. And this has actually been heading up, which could very well help this move that we're seeing in the S&P 500, the NASDAQ 100, and so forth. What else took place? Well, the dollar backed off a little bit, which could very well have helped the S&P 500 and various other assets like gold. Gold has been moving outside of this tight coiling wedge, and you can see it was up 0.68% on the day today, so that's a good looking chart so far. Copper does not look too good, but we are catching a little bit of a bid that could be very well helping the price of the S&P 500 too. I just want to call out that the S&P 500 has been moving up. Copper's been falling and breaking down. That's a pretty negative look overall, and we can look at this from bullish perspectives and bearish perspectives, but the red lines are highlighting where copper made a lower high, but the S&P 500 made a higher high, and we've seen the S&P 500, when that happens, we've seen it catch to the downside. On the flip side, we've seen it where copper makes a higher high, and that could be a leading indicator that we're going to see a move higher in the S&P 500, which we have. Okay, so let's continue on. What else is new? Well, we just reached a new yearly low. Actually, it's even longer than a year, but a new low for 2023. The 10-year, 3-month yield curve is now 189 basis points inverted. The 10-year, 2-year still down at a multi-month low at 72 basis points inverted, which we already know that's not a good sign, right? This is where banks started blowing up and all kinds of mayhem started taking place. So yeah, that's not too of a positive sign. The last thing I want to kind of close off with here is that the Qs have tagged back up to their quarterly expected move. We discussed that yesterday. We said it looks like it's going to be hanging around, is that going to be kind of like the tapping out area for the quarter, where we hang out around 355, 350-ish area. And you can see we are up there today. This doesn't mean that we can't burst through this level. If we do start going through it, you can look at the monthly expected move is right at about 365, and that would be that move up. Just be aware, remember, 68% of the time, if you look at these expected moves as distribution curves, right? Distribution curves, 68% of the time finishes within one standard deviation. And if we start getting outside of this, there's a high probability that we potentially come right back in. So always consider that. I also want to point out that we're getting extended, right, from the 5 EMA. And usually when we get pretty extended, we snap back. We get extended from it. We snap back. We got way extended from it. We snap back, right? We got extended from it. We snapped back. We got extended. We snap back, and so forth. So either this is going to have to catch up, or we're going to come back into it at some point. It's the most frequently tagged moving average. This is on the monthly time frame too. So that's another thing to be aware of. These extended moves don't typically last for all too long. Sometimes you can get big strong moves, but you typically get snapbacks at some point there. So with all that said, how do we kind of interpret this data? I think that we remain bullish once again until we start breaking down from the shorter time frame, the week to date, right? The new month to date anchored VWAP and the 5-day moving average. So if we start breaking down, I wouldn't even really necessarily be too bearish there. Wait to see if price bounces to make a lower high, where we see, instead of seeing a series of, as we discussed yesterday, higher highs and higher lows, you want to see a series of lower highs and lower lows, and that would be a little bit more bearish, where we can potentially see some more downside. But as it stands, like I said, remain bullish. Be a little cautious, obviously, with some of these names, some of the data that comes out, because things could change, obviously, in a heartbeat. So bullishly cautious, manage your money, be very patient and tactical. I can't say that enough. It's the first day of June, and we want to make sure that we have a green month. So that's all I got for you. See you later, everybody.